Not long ago, executive meetings were dominated by growth charts, expansion targets, market share goals, hiring plans, product roadmaps. The energy in boardrooms centered on capturing opportunity and accelerating momentum. Cash was important, but it was rarely the headline topic, unless a company was in distress. In 2026, that tone has shifted. Liquidity planning is now dominating executive meetings, not because companies are failing, but because uncertainty has become structural. Liquidity is the ability to meet short-term obligations without disruption. It includes cash reserves, access to credit, working capital management, debt maturity schedules, and the timing of inflows and outflows. In stable environments, liquidity operates quietly in the background. In volatile environments, it becomes the foundation of strategic control. The first reason liquidity planning is front and center is demand unpredictability. Consumer and enterprise spending patterns have become harder to forecast. Sudden slowdowns can emerge without warning. Corporate customers delay contracts. Consumers pull back on discretionary purchases. Revenue visibility, once projected quarters in advance, now requires constant revision. When revenue becomes uncertain, cash flow becomes uncertain. And when cash flow becomes uncertain, liquidity becomes critical. Executives are no longer reviewing only income statements. They are stress testing balance sheets. What happens if sales decline by 15% for 2 quarters? What if receivables collection slows? What if a major client renegotiates payment terms? Liquidity planning answers those questions before they become emergencies. Interest rate dynamics have amplified this focus. In a higher rate environment, debt refinancing carries greater cost. Short-term borrowing is no longer cheap. Companies that relied heavily on rolling credit facilities are now carefully managing maturities and covenant thresholds. Access to capital cannot be assumed. Maintaining sufficient liquidity buffers reduces exposure to sudden funding shocks. Another driver is the memory of recent financial instability. Over the past several years, markets have seen rapid changes in banking conditions, capital market access, and investor sentiment. Even fundamentally strong companies experienced funding stress when liquidity channels tightened unexpectedly. Executives have learned that profitability does not guarantee resilience if cash is constrained. Timing matters. A company may be profitable on paper, but still face strain if cash is tied up in inventory, capital projects, or delayed customer payments. Liquidity planning focuses on timing, ensuring obligations can be met even if inflows slow. Working capital management has therefore become strategic. Finance teams are closely monitoring inventory levels, negotiating supplier payment terms, accelerating receivables collection, and analyzing seasonal cash flow patterns. Treasury departments now sit at the center of strategic conversations rather than on the periphery. Why liquidity planning is dominating executive meetings also relates to capital allocation. Large investments in infrastructure, technology, acquisitions, or product development require upfront cash commitments. In uncertain markets, executives are asking more disciplined questions. How much liquidity will this project consume? What is the payback timeline? How flexible is the investment if conditions change? Liquidity constraints shape strategic ambition. Technology companies provide a clear example. Heavy investment in AI infrastructure, including data centers, compute contracts, and energy agreements, demands significant capital. Even profitable firms must ensure they retain enough liquidity to manage operational volatility while pursuing innovation. Liquidity planning ensures growth does not compromise stability. Investors are reinforcing this priority. Markets are rewarding companies that demonstrate disciplined balance sheet management. Strong liquidity signals lower risk. It reduces the likelihood of emergency equity raises or unfavorable debt issuance during downturns. Credit rating agencies pay close attention to liquidity metrics, including cash reserves, debt ratios, and interest coverage. Maintaining strong ratings lowers borrowing costs and enhances flexibility. There is also a psychological benefit. When leadership knows the company has sufficient liquidity to withstand short-term turbulence, decision-making improves. Strategic investments can be evaluated rationally. Long-term initiatives are less likely to be abandoned in moments of temporary stress. Liquidity creates optionality. A company with strong cash reserves can acquire distressed competitors during downturns. It can increase marketing, spend when rivals pull back. It can maintain research investment while others cut budgets. Companies with thin liquidity margins, by contrast, often operate defensively. They delay hiring. They postpone product launches. They cut costs abruptly. They focus narrowly on survival rather than strategic positioning. Executive meetings today often begin with liquidity dashboards, cash position, debt maturities, available credit lines, covenant compliance, cash burn scenarios, sensitivity analyses. These discussions are no longer reactive. They are proactive. The goal is not hoarding cash without purpose. It is maintaining flexibility. Global supply chains further reinforce this need. Geopolitical shifts, regulatory changes, and logistical disruptions can increase costs suddenly. Liquidity cushions allow companies to absorb temporary cost spikes without destabilizing operations. Energy price volatility, input cost fluctuations, and currency swings all feed into liquidity modeling. Why liquidity planning is dominating executive meetings ultimately comes down to control. Revenue growth is important. Profitability matters. But liquidity determines whether a company can navigate volatility without compromising its long-term strategy. In today's environment, risk is interconnected and often unpredictable. Financial resilience has become a competitive differentiator. Cash may not generate headlines like product breakthroughs or expansion announcements. But inside boardrooms across industries, liquidity has become the quiet backbone of strategy. Because when uncertainty rises, the most valuable asset is not just growth. It is the ability to endure, adapt, and act with confidence.